It's a new day, but not new news. Gold is breaking heights again, and retail investors are absolutely panic buying at the top. But the charts instead are screaming one word: trap. We aren't here to celebrate a breakout. We are here to issue a warning. The signals for a violent liquidation event in 2026 are flashing red right now. Welcome back to Scope. Today we strip away the hype. We have an asset trading at historic heights, disconnected from real rates and flashing the most extreme overvote signals in decades. Is this the start of a new super cycle, or are we starting at a massive rug pull that sends us back to 4400? Let's look at the data of gold and let's get started.
First, we must understand the change in the asset's personality. Historically, gold is boring. As you can see on the left, for years it delivered a sleepy 7 to 8% annual return. It was insurance, designed to protect wealth, not create it. But look at the right side of the chart. Since 2024, gold has mutated. It is now delivering alpha, with returns exceeding 25 to 30% annually. It is no longer behaving like a defensive rock. It is trading with the volatility and upside of a high-growth tech stock. This shift has pushed price into uncharted territory. For nearly half a decade, $2,080 was the iron ceiling. Every time price touched it, it was rejected. But once that level broke, the psychology of the market flipped. We entered price discovery mode. A vacuum where there are no historical sellers and no overhead resistance left to cap the rally. We have witnessed a massive 200% move from the cycle lows. This is not normal volatility. The market is aggressively repricing the value of fiat currency against hard assets in real time. While vertical moves like this are incredibly powerful profit engines, they are also fragile. When an asset goes parabolic without building support, the eventual correction can be just as sharp. Why is this happening? The old rules are broken. Traditionally, when real yields the green line went up, gold went down. That correlation, as shown in the circle, has completely shattered. This is caused by fiscal dominance. The market no longer cares about the Fed's short-term rate. It cares about the $36 trillion debt load. Investors are buying gold because they believe the only way out of this debt spiral is to inflate it away. There is also a geopolitical accelerant adding fuel to this fire: the weaponization of the dollar. When the G7 froze sovereign dollar reserves during the conflict in 2022, the message to the rest of the world was clear. Your money is only yours if we agree with your politics. Every central bank outside the Western bloc took note immediately. This introduced a new premium called counterparty risk to the U.S. Treasury market. Sovereign nations realized that if their savings can be deleted or frozen with a keystroke, they aren't safe. Gold is the only neutral reserve asset. It has no CO, no central server, no political allegiance, and zero counterparty risk. It cannot be sanctioned. This fear has triggered the whales. Look at the accumulation from the People's Bank of China. While officially reporting steady buy-in, estimates of off-book accumulation via sovereign wealth funds suggest the real number is massive. Why hide it? Because if they announced the true scale of their buying, the price would explode before they could finish filling their vaults. This represents a strategic pivot away from the dollar system. It's not just China. The entire global south is swapping paper debt for physical metal to secure their financial sovereignty. This sovereign bid creates a soft floor under the market price, meaning every time gold dips, a central bank is there to buy it up, which retail investors often don't see until it's too late. However, here is the warning signal. The smart money bought early. Now, the retail money is chasing. We are seeing massive spikes in ETF flows and incredibly consumers buying gold bars at Costco. When the average person starts panic buying an asset at all-time highs, it is historically a contrarian signal. This fear of missing out, or FOMO, usually marks the final, euphoric stage of a rally before a correction. Turning to the technicals, the warning signs are flashing red. We are slamming directly into the 5S and dollar level. This isn't just a number. It is a massive psychological barrier where we expect a wall of limit sell orders. Notice the price action. It is a classic parabolic advance. In financial markets, assets that go vertical do not correct sideways. They tend to correct violently. The most critical indicator here is the RSI, currently sitting at 81. This is extreme overbought territory. We haven't seen a reading this high since the last cycle peak. While momentum is strong, the statistical probability of a pullback to the institutional support zone around $4,400 is increasing every single day. The rubber band is stretched too far. So, where do we go from here? Let's map out the bull case. the inflationary nationalist. For gold to break 5,500, we need President Trump's protectionist policies to trigger a second wave of structural inflation. If we see aggressive tariffs implemented, the cost of goods will spike, forcing the Federal Reserve into a corner. In this scenario, the Fed faces yield curve control. They would be forced to cut rates to save the Treasury market despite high inflation. This returns us to negative real rates, which is rocket fuel for gold. Add in the global fragmentation from BRICS nations settling oil trade outside the dollar, and the path of least resistance is significantly higher. But we must remain objective. There is a legitimate bear case: peace and productivity. If the deregulation of the energy sector and the AI revolution drive a genuine productivity boom, US GDP growth could hit 3 or 4%. This would strengthen the dollar naturally, without the need for high interest rates. Furthermore, if we see geopolitical de-escalation in Eastern Europe or the Middle East, the war premium currently priced into gold would vanish overnight. If the fear trade evaporates and the economy achieves a soft landing, capital will rotate aggressively out of commodities and back into the S&P 500. In this case, gold could bizarrely crash below 4,400. The uncertainty is reflected in the massive confusion on Wall Street. Look at this divergence. On one side, Goldman Sachs is calling for $5,400, betting on the debasement thesis. They believe the debt spiral is mathematically impossible to escape. On the other side, UBS is forecasting a collapse to $3,800. That is a $1,600 spread between the smartest analysts in the room. This tells us that consensus is broken. When the banks disagree this violently, it usually precedes a period of extreme volatility. The median consensus sits at 4,900, which suggests the current price is already fully valued. Our strategy is patience. We are looking to accumulate on weakness. We want to see a washout, a panic sell-off that brings prices back down to the $4,400 zone. That is where the risk-to-reward ratio flips back in our favor. Until then, sit on your hands, enjoy the ride if you're invested, and do not chase the hype. Finally, the stock scope verdict. We are officially issuing a hold rating. We are not selling our core position, but we are absolutely not buying here. We love the asset, fundamentals, the debt, the central bank buying, the scarcity, but we hate the price. Buying a parabolic chart at all-time highs is a classic retail grab.